how inflation affects assets. I'm going to dive into the major asset classes here and lay them right on top of the last 12 months and inflation readings here in the US to see if we can create a little bit of a trend concerning inflation's movement over the last 12 months and the price action of our major asset classes. Try to derive a correlation, and then finally conclude our main segment for today with where inflation is expected to be next month and what an over or under that expectation might mean for these major asset classes. Because we just printed, here as an aside to get us going, we just printed 6.4%, I believe it was, in inflation. And anyone who's been watching inflation over the last 12 months might say, hey, that's decently low. I mean, look at these bars here, 6.4%. That's the lowest inflation reading we've had in the last 12 months. But very importantly, the expectation was actually 6.2% in inflation. So it came in higher than expected, which sent the stock market a little bit lower, sent interest rate markets higher, and really confused all of the different asset classes because they were really expecting a lower number out of our inflation reading, lower than 6.4, that's for sure. So while it might look low, not as low as they'd expected, but that recent story aside, let's take a look at the longer term inflation landscape here and how price action has reflected this inflation landscape. And you can see here, the general trend has been, from the first part of this graphic here, as we look at, excuse me one second. Yeah, as we look at from March until the middle of 2022 going into the fall, inflation is getting higher and higher, and the stock market is getting lower and lower. There's a bounce back right there in the summer, but by and large, a trending lower stock market as inflation is moving higher. We saw the low in the stock market technically around the October print of inflation, which was lower than the peak, but I believe that was at a time where we were expected, you see in that the middle of our graphic here, when we're printing 8.5, 8.3, and 8.2, they were expecting inflation to come in lower. And so the idea was, okay, we printed that 9.1, which coincided with some very low prices in the stock market. And then we came back the next month at 8.5. And then I think people expected, oh, let's get down to 8, maybe in the 7 handle. Didn't get there. And that sent stocks even lower there. But as we got out of that 8 handle down into the 7s and now the 6s, stocks have recovered decently well. We're looking at the S&P 500 here laid on top of our inflation numbers. So not the strongest correlation, but the general trend seems to be inflation higher, bad thing for the stock market. And of course, you can assign a bunch of different economic theories to back that up, which I want to focus mainly on the price action here today. So I don't need to necessarily look into the ins and outs, the inner workings of our relationships here, because I do want to spend time getting to our other asset classes. This one of the more straightforward correlations, inflation to bond prices, negative correlation, similar to the stock market. If inflation's higher, bond prices likely lower because that inverse, the interest rate, is likely moving higher to combat some of that inflation. And so this is where things really get interesting. We started the show by talking about, we get into these cycles, right, of our asset classes relating in different ways. Now, usually you're in, if you read a textbook about the relationship between stocks and bonds, it tends to be bonds and stocks having a certain relationship whereby if stocks are moving higher, it's likely that bonds are moving lower. And what's been really, really interesting is with this higher inflation part of the cycle that we're reaching, bonds and stocks are actually positively correlated here. When we're getting lower inflation prints, the stock market tends to move higher and the bond market tends to move higher, pushing interest rates lower. That's not usually the environment that we're in, but given this, call it an interesting state of affairs here, where inflation higher, interest rates bad for stocks, you're seeing bonds and stocks tending to move with a positive correlation. But getting back to the root cause here, inflation and bonds having by and large that negative correlation, whereby when inflation was really peaking, bond prices were hitting those lows and interest rates were hitting their highs. And now that inflation has come back a little bit, bond prices have bounced back a little bit and interest rates are a little bit off of their highs. Next piece, and maybe the most straightforward piece here, especially when we're talking, keep in mind, we're talking about U.S. inflation during this main segment here. Very positive correlation between U.S. inflation and the U.S. dollar. And we'll take this apart a little bit here in a second, but you can see quite clearly that when we print that 9.1% inflation in July, I believe it was, U.S. dollar breaks into new high territory. And then when we stay in the 8 handle there and we back off a little bit, but we don't back off as much as expected, U.S. dollars run right up to their highs. This is the UUP ETF, which is a basket against, I believe it is like 5 or 6 of the major currencies. But keep in mind, when we reach this peak in U.S. inflation and we stick around there throughout the fall of 2022, that's when the euro goes down through parity. That's when the British pound gets down to $1 and a nickel for a couple of days. And you can see now that U.S. inflation has come off considerably, but not as much as people are hoping necessarily. U.S. dollars are back down to the middle of the range. And now keep in mind, this is U.S. inflation. And to dissect that a little bit is to say that, yes, inflation is still high, and inflation, when it was peaking in the U.S. dollars were also at their highest point. Though inflation is still high, and you might expect, oh, well, if inflation's still high, then why aren't U.S. dollars still high? Inflation in other parts of the world, like the UK, like the Eurozone, like even in Japan, has gotten higher and higher. And in some of those areas, it's 2, 3, 4% higher than the U.S., causing them to look at hiking their interest rates even further, bringing their currency to higher values against the U.S. dollar and pushing that U.S. dollar down here. So many different gears turning in our economy, especially around this inflation, but especially in this Forex space. It takes a little time to get a grasp on it, but it is truly one of the most dynamic spaces and one of the oldest tried and true asset classes that active traders like to take part in here because of all of those dynamics. As a last piece, and I thought this was really interesting, we haven't talked a lot of commodities here in the first couple weeks of this young program. And that's because commodities have been probably the most boring asset class in our economy over the last month or so. And we're always going to focus on what's moving, what's got some opportunity, where the stories are in our economy. But I did want to rope gold into this here because inflation and gold have actually have had a negative correlation here, looking kind of similar if I flash back and forth between stocks and gold here. I'll just go back and forth a couple of times for you to see. doesn't look too dissimilar. And we usually don't have an environment where gold, a traditional flight to quality, is moving in the general same direction as stocks. And I actually, to a coworker, I kind of, as I was writing the show today, I made a little aside to him. I was like, man, are gold and stocks positively correlated, or is it just me? Because this is definitely the most confusing asset class of the bunch, trying to figure out where the heck gold is going from here. And he made a great point, which now I'm going to use as my own point, which is gold seems to be, as a little bit of background before I make that point, gold is an inflation hedge most of the time. That's what it's looked at. So if inflation is going higher, you might expect people to be buying gold for fear that inflation is going to get out of hand and their US dollars or whatever currency is not going to be worth as much. So you might expect, and you did see at the outset of inflation fears at the end of 2021 and into the start of 2022, gold was really expensive. It got all the way back to its highs. But the correlation that my colleague remarked upon, which as I looked into definitely makes sense, is the real rate of return. And by that, we mean, what is the interest rate, save the inflation rate here, totally broadly speaking, but we can only cover so much in this program. And so how does gold relate to that? Well, if inflation is moving higher and interest rates are projected to be lower than that inflation rate, then you would expect gold to move higher. And that's what we saw at the end of 2021 and the start of 2022 was inflation ripping higher and expectations still around interest rates, to be near zero. Remember, in 2021, we're still kind of in the pandemic. What's going on? The Fed needs to keep interest rates low so that we don't spark a recession or a crash. Given this, the pandemic that we're still kind of a part of and all these different gray areas. And so inflation moves higher in 2021 and interest rates don't move higher. And you have gold move to those highs. Well, as inflation got higher and higher throughout 2022, our interest rate and our projections for future interest rates skyrocketed and now have kind of taken over inflation. And so and you saw gold kind of make a comeback in the end of 2022 and 2023 here in the graphic. And that was, keep in mind, when people thought, oh, interest rates will just stay around 4% here in the US. They've hiked up to 3.5%. They'll get up to 4 and they'll stay there. But inflation is still at 6 and 7%. And so gold makes a little bit of a comeback. Why is gold getting crushed in the last couple of weeks? Because now interest rate projections are above 5% and on until 6%. And so again, these different cogs turning through our economic machine, but all relating back to each other. That's the beautiful thing. And the really nice piece, I thought, of looking at price action throughout our major asset classes tied to the last year of inflation here in the US. Where does that leave us? Of course, I want to talk about what could be next for inflation, what that could mean for those major asset classes that we just went through. Well, the most recent reading was expected at 6.2%, comes in at 6.4%. Initially, right off of that, we get our major asset classes trending in the general direction of fear, those general directions that we've looked at when inflation has moved higher, which is stocks edged lower, US dollars moved higher, interest rates moved higher. And since interest rates moved so much higher, gold moved lower there. That story since the inflation reading in the last 24 hours has kind of been muddled. Stocks made a little bit of a comeback. Interest rates, though they are higher, we saw actually a little bit of steepening, the inversion coming out a little. I mean, we're still very inverted, but a little bit inversion coming out, and gold actually still getting hit pretty hard. But that's to say that we're kind of in a middle ground here, which sets up, though it's kind of confused and there's a lot of unknowing, it sets up a really nice piece for the next inflation number, right, my friends? There's usually unknowing and volatility, and we don't know what to expect. All those things tend to be synonymous with some of the greatest opportunity. And so if we hang in the low 6 handle of inflation, let's call it 6 to 6.4% during the next inflation reading, we probably will get some of this similar confused sideways action here, which could be good for scalping. Maybe you get on the other side of some of these big moves. If we see a number come in above 6.4% or above 7%, you would expect rates to be moving higher, stocks to be moving lower, and US dollars to moving higher on these renewed inflation fears. If we come in under 6, we might reverse some of this action that we've seen here. Interest rate project, maybe we don't need interest rates to get that high here. So definitely be watching that inflation number in a month from now. From now until then, you'll see markets moving around, pricing in where they think inflation will be. And thankfully, now you have the correlations. You know what that pricing in will look like.